Hi, this is Anthony and welcome back to my show. As always, before I begin, please click the subscribe button below. It really helps me out and it doesn't cost you anything. Thanks so much. Today I'm going to quickly look at one major stock and then an ETF that contains that stock. Today's stock is Verizon. In the show notes I will include some information from Wikipedia about the company. It's not that long and it is informative, so please be sure to read that. Here is a screenshot of a thumbnail sketch of financials that show revenues, net income, earnings per share, and net profit. Those are just for the most recent quarter ending March 2022. I'll have a link in the show notes to their financials. As always, study the financials carefully before making any decisions to buy or sell. So let's look at a couple charts for Verizon. Year to date, it's down 3.72%. I have to admit that I've found that really surprising. By certain measures of the stock market, we are in bear territory, so a drop of less than 4% is quite refreshing. For reference, the Dow Jones Industrial Average, which Verizon is part of, is down just a little over 14% year to date. Verizon currently pays a hefty dividend of 5.07% based on current prices relative to their dividends. Now, that sounds great, but you want to be careful and not get fooled into making over 5% return on dividends while losing 20% of the value of the underlying stock. Put very simply, don't go chasing dividends. This means don't simply look at the dividend yield and go for the high ones while ignoring that the underlying value of the stock is decreasing. I'm not saying that that's what's happening with Verizon, but that's what's happening with a lot of stocks that currently pay high dividends. Looking back 5 years, Verizon is up nearly 19%, and that is the total appreciation of the stock over the course of 5 years. So you divide that number by 5, and you get that it's only grown about 4% per year, and that's not taking into account dividends. So you do have to account for that. But not a very great return when we've had a tremendous bull market up until recently. For reference, the Dow Jones Industrial Average was up almost 45% over the past 5 years, so about a 9% per year increase. And again, that doesn't take into account any dividends either. Let's just say that you bought shares in the predecessor to Verizon back when they split up AT&T, which was in late 1983. From that time until yesterday, the company was up 550%, though that was over the course of 39 years. If you would have bought and held on, you would have made a respectable 14% per year, not taking into account dividends. So that's pretty good. But if you look at the long-term charts, there are plenty of very long periods in Verizon's history when the price was going sideways for many, many years. Let's look at today's other option. The Dow Jones Industrial Average is an index, but there are a number of ETFs which seek to match its returns by holding the underlying stocks that make up this index. One of those is the SPDR Dow Jones Industrial Average ETF Trust, stock symbol DIA. I think many investors are familiar with the Dow 30, but I'll put up a long-term chart for your viewing pleasure here. Looking at the chart for DIA, it only goes back 24 years, but if you held this ETF, it went up just over 307%. And in 24 years, that's roughly a 12.79% annual increase, not taking into account any dividends paid on this ETF. Yes, there are 30 stocks held in this ETF, and all now pay dividends, though the dividend rate is going to fluctuate quarterly based on what the dividends are being paid by the underlying companies. But it's likely going to be much less than what dividend is being paid by Verizon. Remember, I'm not giving investment advice here, just entertainment. If you're interested in one or both of these, I'll have some links in the show notes where you can do further research on the financials, in particular for Verizon. I think if I only had these two options to choose from and had to pick one, that would actually be a very difficult decision to make. Verizon probably makes most of its money from its phone service, and people aren't going to get rid of their cell phones anytime soon. And whether they lose their job or the recession occurs or there's higher inflation or the stock market goes up or down, people are still going to use their phones and pay their phone bills monthly. If you're looking simply at the numbers and the historic trends along with dividend yield, Verizon does seem to be the slightly better investment. The risk is the company might decide to make a purchase which turns out to be a large mistake and hurts earnings in the future. There's been a trend fairly recently for telephone companies to try to get into media. We saw that with Verizon buying AOL and Yahoo, And AT&T bought Time Warner, which incidentally had been combined with AOL at one point. I understand the theoretical attraction to buying legacy media companies with all their content, but if you look at the history of such mergers and acquisitions, they rarely pan out financially for the acquirers. The Dow Jones Industrial Average, on the other hand, has 30 components, all of which give the leaders of those companies the opportunity to make good or bad decisions. But if a company does too poorly, then it could be removed by Dow Jones from the index and replaced with another stronger company. So there's a self-correcting mechanism for that security to get rid of bad components and replace them with better ones. For that reason, I think that if I could only buy one, that it would probably be going with the Dow Jones Industrial Average ETF. But that's taking into account that over the long run, historically, you probably would have made slightly more money with Verizon. And of course, you rarely only have the option of investing in one security. If you like both of these, put half your money in one and half in the other. Or 25% of your money in Verizon and 75% of your money in Dow Jones. Or whatever combination you want. And of course, there's thousands of good stocks out there. Don't just look at these two candidates. As always, do your own research and take into account as many factors as possible when making decisions to adding to your well-diversified long-term portfolio. That's all for today. What do you think? Please leave a comment below. Thanks for watching and good luck in investing.